The market is not all technology, Victoria, but we sure do love it, and investors love it, and it gets a lot of attention in, the article du jour in the journal. Today's article du jour is tech's dominant decade in the market fades. Does that mean that it's going to keep fading, or does that mean, wow, everything's on sale that we loved a year ago?
Yeah, so Joe, I think I would be more in the latter camp on that one, but that doesn't mean you jump in with both feet and buy all tech names that are out there. Our focus right now, with all the volatility that's going on in the market, is really to focus on quality, right? The quality of companies, quality of the balance sheets, quality of earnings. So you look at some of these high growth names in the tech space, names that have come down, valuations have come down, but they're companies where they have strong cash flows, where they're going to be long-term holdings in your portfolio, then I think you do go in and you buy some of those names. I mean, Microsoft and Apple are still two of the largest holdings in our large cap strategy, and that hasn't changed. That doesn't mean we don't go in and buy some other tech names. We like some of those old school tech names because we think you have that longer, slower growth potential with them with less volatility. So you're looking at a name like Intel that's come back because of some of the news. You look at a name like Texas Instruments. So I think you need to be choosy and have exposure to tech, but probably not as much as you did a year and a half or 2 years ago.
If you recall, when we were waiting for yields to rise on the 10-year, waiting, and everybody knew they were going to go up, and everybody said, you better watch out for tech because tech is the area where multiples are high, and they're going to be affected. And when interest rates go up, multiples contract. That's going to be trouble for tech. It's exactly what's happened. Almost, as we've seen it from 2.25%, 2.5% up to 3%. So we shouldn't be that surprised, and it all kind of makes sense. Now predict what goes on from here. What if we stop at 3.5%? Does tech find a footing?
Yeah, I think the whole equity market finds a footing here. Yes, those tech names are long duration stocks. So obviously when yields move higher, we see those prices affected more than some of your value names that we consider more short duration stocks. But look, we think yields have kind of found a range here in that 2.80 to 3%. We're right on the 3% level right now. We actually think the highest we might go this year is back to that intraday 320 level that we saw earlier in May. If that's true, then I think tech can find also kind of a trading range to be in. And that's kind of what we're looking at. It should support the equity market as bond yields start to calm down a little bit. Obviously, the CPI number tomorrow, that could be a game changer. But I think unless it's higher than people expect, then you will see yields start to calm down a little bit. That's supportive of equity and tech.
We've also started separating out food, and people do that. Obviously, there's something called core, but people are very bullish on oil, and I don't know whether that means they're going to be right, but both fundamentally and technically, most people think there's a way it will go above 130, maybe even above 140. Maybe it doesn't. But are there other positive signs in terms of inflation moderating in different areas? Can we handle that if oil goes to 145? In terms of inflation, that could mean interest rates need to go higher than 3.5.
Yeah, absolutely. I mean, energy is that leading sector right now, and that leadership has not changed, which tells us that month over month inflation may not have peaked. I think year over year, when we look at CPI, the headline, the core numbers, yes, that has probably peaked. It's month over month that we want to see peak. And with energy as high as it is, I'm not sure that's happened. But look, we've got the labor market moderating a little bit. We saw that in the numbers last week. We've got durable goods prices that are moderating a little bit, and supply chains that are starting to look a little bit better with China reopening. All of those should help bring inflation numbers down a little bit, including what we're seeing in the housing market. So I think with all of that together, we don't get a recession. We have a better opportunity to get a soft landing. That should help all of that and give the Fed maybe a little bit of room to go 25 basis points in September, even though we've been hearing some of the Fed presidents say they're not ready to go that route yet.
Shepard Smith here. Thanks for watching CNBC on YouTube.